The idea is generally that stablecoin market cap doesn't bear the end user any yield. And so let's see if we can convert some of that stablecoin market cap into our products and services, i.e. in the first instance, tokenized money market funds. Step two of that though, and at this point, like tokenization tech is generally pretty commoditized, right? It's really the integrations and BD and go to market and education that they ultimately should be spending a lot of time on.
Today's guest is Morgan Krupetsky, the VP of Onchain Finance at Ava Labs. She sits at the center of Avalanche's institutional strategy as major financial institutions increasingly use blockchain rails for settlement, tokenization, and programmable finance, to say the least. Morgan, maybe to start off, we've had this conversation a lot on the show before, but like over the past year, the conversation around crypto has really shifted away from speculation, trading, etc., more to infrastructure, tokenization, institutional adoption, which I'm sure you're seeing internally too. So maybe at a high level, what do you think has changed institutionally that has kind of made tokenization more real to the traditional financial audience and really bringing like this on-chain finance world to fruition?
Yeah, and thank you for having me, Jacquelyn. It's good to see you as always. I think maybe at a high level, there's just been such a large degree of like institutional FOMO that has really started to permeate the industry, and it's super interesting to see. I started at Ava Labs 4 years ago, and my sole mandate at the time was just to focus on getting banks, asset managers, and FMIs to leverage Avalanche in the context of their blockchain and digital asset strategies. And really since then, and you kind of alluded to this, we've really seen this kind of convergence between TradFi, DeFi, CeFi, tokenization, and further supported by a much more conducive, especially in the US regulatory environment, which just all has kind of come together to create a perfect storm for institutions to really start to really invest in the space. And so I would say over the past year in particular, you know, obviously Genius passing has been huge in terms of enabling or prompting enterprises to create stablecoin strategies and figure out kind of how and what they should be doing in the space. And that I think has been coupled with institutions really seeing how much stablecoin market cap there's been on chain. And that in turn has prompted them to really get excited about issuing and offering tokenized money market funds in the space. And as more enterprises have got involved, i.e., you know, Stripe acquiring Bridge, DTCC announcing plans, NASDAQ, others, it's really, again, kind of created this institutional FOMO, if you will, where now, especially as we kind of go through and look to clarity, hopefully being passed in the, you know, in the future, we're seeing all these different types of financial services institutions start to staff up significantly and really build and grow out their digital asset teams. And I think that that will continue. So I think it comes down to institutional FOMO.
Yeah. Do you find that the strategy across these different institutional teams is similar, or they all kind of want different things?
Yeah, that's a good question. I think it depends. And I think like historically crypto has just lumped like all the institutions together, and it's like a lot more. Yeah, it's like the institutions. I was gonna
say institutions totally. Is such a generic term. I know.
Yeah,
define institutions. Yeah.
I mean, there's so many different types, right? Like you have asset managers who are called or generally referred to as like the buy side. And even within asset managers, right, you have real money, like sovereign wealth funds, pension funds, endowments. You have hedge funds. And then there's, you know, further kind of breakdown within that world. Then you have banks, like incumbent banks, but then you also have neobanks and wealth tech platforms. And then you have like central banks. So there and FMIs too, right? Like exchanges and a lot of the infrastructure. So all that's to say is, depending on the type of institution that they are, will kind of generally dictate the type of strategy that they drive forward. So far, when I've seen kind of these institutions deploying various strategies, in the first instance, it's generally been a function of what they feel like their clients, whoever they may be, institutions, retail, are demanding. or are requesting. For that, for example, when you're talking about like an asset manager who's been issuing money market funds, generally the idea is that there's more crypto native kind of institutional demand on chain for these products. And so that's why a lot of these asset managers are starting to issue money market funds in the first instance. With banks, a lot of their kind of first foray into the space is enabling their clients to access Bitcoin and ETH, right, in potentially ETF form, and then potentially the ability to borrow against those things. And then obviously they'll kind of grow from there. But a lot of it's ultimately been dictated by client demand, because I think for them, as they make the case internally to dedicate more resources to this space, they'll have to show proof points of traction and revenue generation. Eventually, I think we'll get to the point where they'll be adopting the technology in the context of their own businesses and their own operations because they feel like it's worth it to do so, either from a risk and control perspective, from a revenue perspective, whatever that might be. But a lot of them in the first instance are kind of trying to identify the relatively lowest hanging fruit way to kind of like dip their toe into the space and offer new products and services that their clients are demanding.
What would you say is the low-hanging fruit right now? Like an entry point, if you're talking to a team and they're trying to figure out their strategy, you're like, hey, maybe let's start here.
The most obvious kind of lowest hanging fruit in this space so far for asset managers has been money market funds, right? And so the idea there is all of these asset managers who manage a collective trillions of dollars of traditional money market funds have seen the growth of stablecoin market cap on chain over the past X amount of years. And the idea is generally that stablecoin market cap doesn't bear the end user any yield. And so let's see if we can convert some of that stablecoin market cap into our products and services, i.e. in the first instance, tokenized money market funds. The step two of that, though, and at this point, like tokenization tech is generally pretty commoditized. So it's not just issuing the money market fund, and this is where we spend a lot of time with our asset manager partners on this, is, the issuance is almost like the easy part, right? It's really the integrations and BD and go to market and education that they ultimately should be spending a lot of time on, because again, issuance is just kind of step one. And so that's really where we were spending a lot of time with our partners and almost doing like BD and go to market with them and plugging them in with net new opportunities, not just in the crypto native space, but in the traditional space, plugging them into, again, like wealth tech platforms, neobanks, fintechs, where those enterprises already have customers. And you can kind of plug in a tokenized money market fund, for example, in a way that obfuscates the crypto complexity, but now offers, especially in the global South, like a net new product for someone who historically hasn't had easy access to it.
Yeah. Would you see these tokenized money market funds almost like as a gateway into the space often? Like it's a starting point?
Yeah. So, I mean, I think like the kind of order of operations, especially when we're talking about end users in LATAM and other parts of the global South, where potentially they don't, again, have ready or easy access to a lot of these products. The order of operations that we see is kind of akin to like an embedded finance stack, where the first port of entry is stablecoins, right? Access to dollars, could be USDC, USDT, or the whole slew of other stablecoins that are continuously being launched. And then by extension from there is the concept of like a digital savings account, and that could take on or be powered by a multitude of different products in the back end. Obviously, money market funds are one, DeFi integrations with an Ava or a Morpho, for example, or another. And then from there, there's obviously a whole slew of potential investment products that could be offered in tokenized form, whether it's fixed income or equities or whatever that might be. And then finally, to kind of like close the loop, is the idea of like a stablecoin backed card product, which will enable a user to spend down their stables anywhere Visa or MasterCard is accepted, in a way where they don't have to necessarily kind of go through the experience of off-ramping. And that really kind of completes the embedded finance stack that we're finding really resonates with a lot of these platforms who, again, either don't have easy access or the access is really annoying or costly or whatever that might be. And so that's what we're seeing resonates with a lot of these enterprises.
Yeah. I mean, we've seen a lot of these firms ranging from like BlackRock, Citi, JP Morgan, KKR. I think all, if not most of them, have worked with you guys, and major like financial firms along that side, like experimenting or implementing on the infrastructure side. So do you think the institutional adoption here has kind of crossed the chasm, so to speak, and now it's more of like, to your point, that convergence where, you know, it's working hand in hand opposed to like some experimental project that they're like trying to get across to the MDs or something?
Yeah, that's a good question. I mean, I would say like even when I started at Ava Labs, luckily we were at a point even back then where we weren't necessarily convincing our partners of the merits of blockchain. Like a lot of them already had a semblance of a blockchain and digital asset team. So even back then, the conversation was, you know, what is Avalanche and why Avalanche versus others, and what are the various use cases and applications that that this technology is conducive for. But obviously, since then, like to your point, I think we've definitely crossed the chasm in terms of, I think there is a buy-in that this technology is here to stay, and that is also now fueling, even if it is pilots and POCs, it's not pilots and POCs for the sake of a pilot or POC just to say that you've done something. The idea is really to be able to ultimately scale to an in-production deployment, but you're doing a pilot or POC because it's low lift, because you want to prove it out, whatever that might be. But the ultimate goal is to leverage, you know, the application, you know, ultimately in an in-production environment. And what I'm excited to see is, you know, again, we've talked about how all these different institutions are creating products and services for their customers, but I'm excited to see the time where you start seeing, for example, asset managers of various types actually putting capital at risk into various opportunities on chain and trading and transacting with banks or with each other in a way that leverages the technology, which means that the tech is providing them with something that is functionally better than leveraging legacy rails. And that I don't think we've come to yet. Again, there's a lot of pilots and POCs happening, but I think in, 5 years, we'll start to see, the ins and outs of the plumbing being upgraded.
Yeah. What would you say is the average duration for these pilots or POCs?
That's a good question. So I think a lot of our early success with institutions, and you mentioned a few of them that we've been working with, came from the fact that we're the adults and kind of professionals in the room, and there's a lot of people at Ava Labs who came from the traditional financial services space and who can kind of like toe the line in both worlds and really develop like trusted advisor relationships with a lot of our institutional partners, where it's not just a function of us meeting with their engineering teams and doing a tech deep dive in terms of why the tech is good, but also conceptualizing use cases and helping them make the case internally to internal stakeholders, whether it's compliance, legal, business, regulators. And so all that's to say is, in general, like the whole process end to end, from like when we meet an institution to when, we actually launch something, it takes a long time. It's a long sales cycle. My mom tells me I'm doing God's work. And so some of the like for example, like we worked with JP Morgan on a few initiatives. We worked most recently with Broadridge, and both of those things, like we'd been talking to them for like 2 years before they were like, okay, like we have something to do. We're ready to do something. Like, can you support us in this endeavor? The time it takes to actually like implement something, to the extent that there's resourcing on the other side to actually operationalize something, it doesn't take as long as people think, especially in the context of Avalanche L1s. Those are spun up trivially quickly. So I guess it depends on like how involved it is and how many institutions are involved. But I would say end to end, it takes a while. The actual implementation, not as long as I think people people think.
Yeah. The reason I asked that is because I've heard the same thing where it's like so much is happening on the back end, it just hasn't been announced yet. Or like the things that we see announced now were actually in the works for the past like 12 to 18 months. So like while everyone's saying like, oh, it's trendy, this is a hot narrative right now, it's like actually people were reading the tea leaves like long before they announced it. And it just takes time, a lot of these things, right?
Yeah, totally. And yeah, it really does. And um, it's interesting and also kind of like validating to see the fact that the industry has woken up to the fact that institutional adoption is important, and that the industry is evolving from focusing on kind of speculative and crypto casino types of use cases to actually leveraging the tech for real world pain points or to drive forward strategic imperatives. So that's something that we've been working on and prepared for years. And so it is kind of cool to have seen that like progression. And now, it feels like we were almost like made for this moment.
Yeah. How does Avalanche, or I guess Ava Labs, position itself in a way that's like, okay, we're thinking about the sophistication of these traditional players. We understand the needs that they have, the guidelines and frameworks that they need to operate within, but then also like still bringing that DeFi innovation to the table and making it more accessible, on that side of the thing, or that side of the spectrum, right? Because like I know for a lot of these DeFi protocols that are being built on top of Avalanche or on top of like any chain for that matter, is like they're a lot more experimental, and they push the envelope a lot more than like a traditional product or fund would, right? So like when you're thinking about the DeFi opportunities and tying those into these traditional markets, is there anything on that front that you feel has been limited, in terms of like, okay, if we're going to get institutional adoption, we need to dial this back? Or is it still kind of like an open playing field?
I would say, it depends on the institution that you're talking to, how like progressive or like deep in the space that they've been and kind of their like level of knowledge. But I think from an Avalanche standpoint, we've been fortunate given the architecture of the network, where if someone wants to go full degen and deploy on C-Chain and integrate various DeFi protocols in the back end, they can do that. But if they want to start out in more of like a walled garden that meets their regulatory and compliance requirements as it relates to chain level permissioning and smart contract deployer permissioning and validator permissioning, but still have the door open to being connected to a broad-based public network, like that's also a path. And then also the fact that you can start in that environment and kind of graduate to a little bit more of an open network is also an option as well. So that's actually what led to a lot of our early success before the election in the US, when banks in particular were very reticent to touch public permissionless networks. We're like, great, we have a hybrid solution for you where you're not deployed on a public permissionless network. You still have all those kind of controls in place, but you're not, an enterprise blockchain off in the middle of nowhere with no connectivity. And like at that point, there's like no point to be on a blockchain. So right. Again, like I think the Avalanche architecture has always been very conducive to that like spectrum of options. And then in general, I also feel like DeFi is growing up. I think there's like not just the teams that are formulating and driving forward the Aves and Morphos of the world. They're starting to also be much more attuned, I think, to institutional requirements, right? And for example, our friend Luigi, who came from Avalanche, just started at Aave, right? And he and I were in the trenches together in the early days working on institutional adoption. Like, he knows what's top of mind for institutions. He came from TradFi. And so he's also able now to kind of sell into banks and asset managers and fintechs in a way where it's not just like, here's the docs, like, figure it out. So I just think in general, like the industry is growing up, and it's nice to see, because I think frankly, at the end of the day, for as many like users and market cap and liquidity that exists on chain today, the large majority of the liquidity and users still are off chain. And so to the extent you can like tap into that world through existing distribution channels, the more I think you'll bring net new users, net new capital and liquidity on chain writ large.
Yeah. I mean, Avalanche has become one of the largest ecosystems for tokenized real world assets. I think it surpassed like $1.3 billion. Correct me if I'm wrong.
Yep, you're right. But with definitely more to come.
Yeah.
But
Yep.
as we all look at the dashboards, is that reflected yet?
Yeah. I guess like, yeah, what is the
Yeah.
mandate on your side? And then what would you say has resonated so strongly with institutions over the years with
Yeah.
Avalanche specifically, right? Because like passing that billion marker is not something that all these teams have done. But obviously you guys have gone over that rail, right? So like, what would you attribute to that?
Again, like for as long as we've been focused on institutional adoption, we've been focused on tokenization, right? The stated mission has always been to digitize and tokenize the world's assets. So I think it's something that we were focused on, not because it was a trend or the like new narrative or meta, but it's something that we've like staunchly believed this technology is like conducive for. So it's been a core strategic focus for quite some time. And because of that, we were very early to focusing on cultivating an ecosystem of higher quality assets. And again, not financial advice, but higher quality assets as issued by, large traditional asset managers. And so for some time, our focus was just that, on really creating sufficient like asset supply on Avalanche. Now, our focus has very much shifted from a BD perspective to the demand and distribution side of the equation, and finding different demand vehicles and channels to kind of plug in this ecosystem of tokenized assets into. And so our tokenization lead, Olivia, has been pounding the pavement with, I don't know, I think she has like a list of 1,500 fintechs and very traditional fintechs that she's reaching out to plug into this ecosystem. And that's, again, for us, like where we get really excited is where we're bringing in more like traditional users and capital. And that could be, again, retail or institutions. But for us, that means net new capital, net new users, generally stickier users, and non-mercenary users, right? As a lot of DeFi actors are. And so that's been, I think, a differentiator for us as an ecosystem where firms that we meet with that are looking to tokenize their assets, I think this kind of BD approach has really resonated with them.
One of the biggest promises on the front of tokenization is increased liquidity. And I feel like a lot of conversations I have recently is like a lot of these tokenized assets still trade in relatively closed ecosystems. And not all of them come with liquidity, as I'm sure you're aware. And I think sometimes people think like, oh, if I just bring it on chain, it'll come. And like, that's
that'd
not
be cool.
how the markets work. So what do you think would... Yeah, I know, right? Like, let me just bring anything on chain and suddenly it's a liquid, amazing market. What do you think would need to happen then for like a really global liquidity event to happen around tokenized assets, or for it to emerge maybe more so?
Like if an asset is illiquid off chain, it doesn't mean that it will suddenly become liquid on chain. I think the tech that is like tokenization and token standards and smart contracts and blockchain technologically enables for the seamless and quick transfer of value. But if you have siloed platforms, siloed legal approaches and regulatory approaches, like digital money that is not easily transferable from platform to platform, siloed KYC, all of that stuff kind of creates frictions in terms of the liquidity component, right? So things are not standardized and things are therefore kind of bound to the particular implementation across different networks. And part of that, I think, could be because we're so new, we're so like nascent in this industry where certain standards and certain platforms haven't won out. But I think there's also, unfortunately, like a totally non-crypto element that's more regulatory in nature that needs to be resolved or navigated, right? Like for example, today, if you're KYCing with one bank, you can't leverage that KYC credential with another bank, right? Like you still have to onboard with that other bank. And that's like a regulatory construct that, sure, technologically, you can leverage one digital ID on another from one platform to another. But if the regulation and the two businesses don't allow for it, then it doesn't matter. So I think that there's like technological issues that the industry needs to work through, which are relatively, I would say, like easier to work through, rather than there's still, again, like regulatory questions, which I think still need to be addressed that are, obviously we're talking about like global regulations. It's like a whole other can of worms. Yeah.
It's a whole nother ballpark. Yeah. I know Avalanche also expanded pretty big in the front of Latin America, the global South, et cetera, through payments on the front of like, through partnerships focused on payments.
Say that 5 times fast.
And tokenization, blockchain infrastructure. Yeah, yeah, I know. A lot of similar words there. But I guess what is the thesis in those markets for expansion opposed to the US, Europe, and other like more developed markets too?
To kind of like take a step back, and you probably have heard this before, but like the current global payment system still ultimately relies on fragmented correspondent banking networks, the concept of pre-funded accounts, batch processing, obviously limited banking hours. And therefore, because there's disparate systems being used, really heavy reconciliation that needs to happen from one system to another system, as well as like constant message passing from system to system. Right? That's why like SWIFT kind of came about. And obviously collectively, that is does not happen automatically. There's ultimately non-instant settlement. There's trapped liquidity, right? If you have to pre-fund and you have to guess how much you have to pre-fund as like a multinational corporation, all these different jurisdictions. And inherently that's a huge like opportunity cost. And generally there's pretty poor kind of transparency from entity to entity, especially when you start talking about like cross-border payments. Yeah. So collectively, because blockchains enable a uniform value transfer and settlement rail, and stablecoins generally use common kind of like token standards, you can therefore have things like near instant 24/7 settlement, real-time, obviously, visibility into transactions, although there's a whole privacy component which we can talk about. And therefore, really importantly, you no longer need a lot of these intermediaries and constant message passing because everyone's leveraging the same rails. Although it's funny that people say rails because like, what is a rail? But the same network. And what is a rail? But because of that, like you don't need a lot of these third-party service providers or intermediaries that, by the way, all take their fee. You can leverage this kind of common value transfer, trade and transaction rail. And so that's really the basis for all of the, startups that are being built on blockchain rails that are helping to solve a lot of those issues for not just individuals as it relates to things like remittance payments, but also for businesses, whether intra-company for intra-company kind of payments or B2B cross-border payments as well. Within the Avalanche ecosystem, there's a bunch of examples, but one of the most notable ones is our partners at Axiom, who are already working with and plugged into very large kind of payment aggregators and payment processors and enable a lot of, again, multinationally reaching companies to, for example, not have to pre-fund accounts globally and in these various jurisdictions. Instead, they can manage their treasuries much more efficiently and centrally and send money to where it's needed on demand and instantly because Axiom uses stablecoins in the back end. And so it really helps from an operational standpoint, their clients who now have a much more kind of capital efficient operation.
Are there any other partners in the space right now building on Avalanche that, like Axiom, are really focused on this?
Yeah, so I mean, it's interesting because what people say like stable coins are like the killer use case. And I mean, it's like they power various use cases, obviously. So cross-border payments are huge. And
Sure.
also what we're seeing is very interestingly, stablecoins powering a lot of the work that we're doing in the private credit space. And because various tech enablement partners on Avalanche are leveraging stablecoins in the context of operations, for example, fence finance or tranched, they're able to process credit facilities, for example, much more quickly and intraday. Whereas historically, for example, if an originator was borrowing from a credit facility provided by, let's say, like a private credit firm, using traditional or legacy payment methods, that facility wouldn't be able to be funded on an intraday or even on a daily basis. And so as a result of that, a lot of those originators would have to kind of draw down from their own balance sheet, which is, very expensive from like a cost of capital perspective. And it's just inherently a better experience to the extent that they can draw down from the facility daily because it's using stablecoins in the back end. So it's just interesting to see now all the various kind of applications being built with stablecoins being a huge piece of like the infrastructure that is powering or that is enabling that use case. And especially over the past, I would say like year and a half, the infrastructure around stablecoins has also improved in terms of increasingly zero cost on and off ramp capabilities. And obviously wallet infrastructure and all the other stuff like around it has also improved and I think will continue to improve. But that's really something that's come up, I would say, in the past like year and a half, 2 years.
Yeah. Why do you think stablecoins have succeeded so much when like other early crypto payment narratives struggled, or even just like other crypto assets? I feel like stablecoins were probably like, aside from Treasury or U.S. Treasuries, like tokenized money market funds, etc. Stablecoins were one of the biggest like tokenized cash narratives that like has early adoption success by a metric standpoint. Obviously, like there's still a lot of room to grow, right?
Yeah.
But like, what do you think kind of drove that? Was it just like easy to understand for a lot of these traditional players, and it makes sense that it's like this one-to-one dollar-backed asset, more or less? Hopefully.
Yeah, hopefully that's the intention. It's stable. Yeah, I mean, I think that's exactly right. Like, I think inherently, crypto as a cryptocurrency, as an asset class, is pretty volatile. And so, as a payment method, it's probably not the best. Well, I'm sure there's many in the industry who will argue with me on that. But relatively speaking, it is more volatile than stablecoins. And so as a form of payment, or even as a form of kind of savings or a holding of wealth perspective, stablecoins have definitely emerged. Even I think, and part of the reason why I think we have such like a large market cap of stablecoins today is there's, individuals and institutions out there who've profited from crypto and who've taken money off the table by reallocating to stablecoins. And so that has been just this like, the way that the dollar is served in the real world is how it's been kind of serving a lot of kind of crypto capital in the on-chain world. And so that, coupled with to your point, that institutions look at stablecoins as digital dollars, especially post-Genius. Payment stablecoins is something that they've increasingly become comfortable with. I don't even think institutions have even conceptualized the idea of using crypto for payments. And so I think stablecoins is a way for them to get comfortable with the fact that it's digital dollars, it's one-to-one, it's especially these days more regulated. And so that's something that they've been definitely kind of leaning toward, especially when you talk about payment methods.
Yeah. You also mentioned private credit before. What do you think makes it so well suited for blockchain rails? Because obviously we have private credit in the traditional markets, right? But then when it comes into on-chain finance, what do you think these lenders and borrowers really want or are getting from here that they can't get in the normal world? Normal world, the traditional
Yeah,
world.
the normal world.
Yeah.
Normal world. So we, as I mentioned, obviously we've been focused on tokenization for quite some time. Within that huge world, private credit and specifically asset-backed finance and fintech lending is something that we've been like especially focused on, and really kind of cultivating an ecosystem of originators, both traditional / like Web 2 originators, as well as more blockchain native originators, plus capital allocators, plus credit infrastructure platforms, and then ultimately distribution channels. This is something that we've been hugely leaning into and will continue to do so, because I do believe that unlike potentially equities or other areas, it is still a pretty inefficient market. It's pretty opaque. It's pretty non-standardized. And there's a lot of problems in the traditional ABF space today. For example, double pledging of collateral and not being able to kind of like catch fraud in real time or manage compliance in real time. A lot of those issues are real world issues that can be solved by this technology, which is something that is a novel concept, right? This tech solves real world problems, but it's a concept that really resonates with when we talk to like private credit firms and originators. They can get on board with it. They're like, oh, I can actually use this tech to solve something that like I deal with in my day to day already. And that's what gets us excited, because we're not just slapping a wrapper on something and providing no reason for traditional investors to access the same asset on chain, which by the way is often like more frictionful, more expensive, and like obviously becomes less liquid. So this is really a space that we've been kind of doubling down on. The one other thing that I would add is a lot of the like tokenized funds, or a lot of the tokenization efforts that we've seen today, they introduce the technology, i.e. blockchain tokenization, at the fund level. So once like a fund is formed and there's, investments that go into the fund, that's when tokenization is introduced, and often adds more administrative friction, because you still have to administer and manage the fund the traditional way plus the tokenized way. To the extent that you can introduce the tech instead as upstream as possible, right? In the point of native on-chain equity issuance, native on-chain loan origination, that means that the source of, birth of the asset is the blockchain. Yeah. And because of that, you can proceed with full, like end-to-end on-chain servicing and verification and administration, like lifecycle management, because every relevant party is now referencing the same source of truth, which like that's like the whole point of being able to solve a lot of these issues that kind of we're experiencing today, especially in private credit, for example. And also, going back to my original point, removes the need for a lot of kind of third-party service providers that historically like were needed, because not everyone was leveraging the same source of truth. So we're we're purists in that form, but I think like the industry recognizes that. But I think like the private credit ABF space is ripe for adopting that sooner than later. Whereas within like the world of equities, which obviously a lot of different institutions are focusing on tokenized equities, but that will require like a much greater overhaul, I think, of that market versus something like private credit, which doesn't have as many is not like traded on like an exchange in the same way that like equities are, for example.
Yeah. Do you find that like the traditional lenders and borrowers are starting to grasp this concept more, or is it still a learning curve?
I would say yes to both. Like they're starting to grasp it more, but there's still a learning curve.
Yes,
Totally.
it still
And
requires, yeah.
luckily, like we have partners in the space, whether it's the team at Grove, the team at Tear, the team at Valinor, who again kind of come from the private credit world and have been really serving as like the educational shepherds, if you will, of a lot of the traditional private credit firms, because again, they can speak their language and they can explain how and why what they're working on, why this technology is something that they should care about from a business perspective. And so as the space has grown up, we've attracted more of this kind of talent that can help handhold institutions through the educational process. And yeah, I mean, in certain senses, we've seen firsthand, we've done a variety of different kind of pilots with real world originators where I've seen aha moments like on a phone call to think like, oh, I don't have to spend half a day once a week reconciling an incoming loan request with an Excel sheet. Like they're definitely having these aha moments, and it's really cool to see because it's unlike historically where blockchain has been like a solution in search of a problem. We're now starting to see these business cases kind of resonate with the real world enterprise and institutions that ultimately is the reason why I kind of got into this space in the first place.
Yeah. What is something that hasn't been built yet that you'd like to see built on this front for on-chain finance?
That's a good question. I mean, I think in general, what we will have to see and kind of drive forward as an industry is, and it's improved, but like the continued obfuscation of this tech in a way where it doesn't like scare people or institutions and is kind of plugged into where like they where they interact or how they interact today. So like for an institution, a lot of the times institutions interact via like Bloomberg, or they leverage Bloomberg, or whatever kind of like OMS or trade system that they use. It will be exciting to see like when these assets or when these opportunities are kind of plugged in there in a way where the user experience is pretty seamless and can kind of be a part of an institution's kind of portfolio if you're talking about crypto, for example, or in the case of like private credit or equities, in a way where people no longer delineate between tokenized assets and regular assets, where they're just look at it as like Apple stock, and Apple stock is Apple stock. It doesn't matter if it's like tokenized. So that I think pertains to institutions as well as like individuals in retail. But I'm excited for when that point comes, because I can't say RWAs anymore. It's just kills me. Yeah, exactly.
I'll just say assets. Yeah. All right. Last thing, Morgan, can you leave us with a piece of advice, something that you've carried with you throughout your time in the space, or maybe even from your old school finance days?
I would say that on the one hand, like there's so much information out there to kind of get up to speed on and kind of keep up with developments in the industry. So I would encourage people to like take advantage of it, and then also like I have found in my time in the industry and even before that people are like pretty generally happy to like talk, meet for coffee, impart knowledge, wisdom, connect you with other people in the industry. So I think as people navigate, either people that are coming from traditional industries into this space or looking to kind of like navigate within this space, like I find that people are pretty willing to kind of sit down and give you their time. And so I would encourage people to take advantage of that.
I love it. Amazing. Well, Morgan, thank you so much for coming on today.
Sure. Thank you for having me.